In the super competitive world of digital banking, there's one number that can literally make or break a company. And right now, it's climbing fast. We're talking about customer acquisition cost, what you pay to get a new person to sign up. So today, we're going to break down how you can get that number under control before it starts controlling you.
So let's just start with the most important question you can ask. Are your new customers actually costing you more than they're worth? I mean, think about it. Are you spending $1 just to make 50 cents back? It's a trap, and you'd be surprised how many fintechs are falling right into it.
You see, a high customer acquisition cost, or CAC, is like a silent killer for growth. It doesn't make a lot of noise, but it's in the background, quietly draining your resources, making real profitability feel like it's always just over the horizon. Honestly, for a lot of digital banks, this is the single biggest thing holding them back.
So why is this happening? Well, it's kind of the perfect storm, right? The market is absolutely flooded with competitors all fighting for the same eyeballs. That, of course, drives up the cost of digital ads through the roof. And on top of all that, you've got the challenge of convincing someone to trust you, a new digital bank, with their money. That trust is tough and expensive to build.
Okay, so that's the problem. The good news is there's a solution. It all starts with getting a handle on one single metric, the lifetime value to customer acquisition cost ratio. Seriously, you should think of this thing as your compass for growth. It'll tell you if you're heading in the right direction. Let's break that down real quick. First, you've got LTV, or customer lifetime value. This is the value part of the equation. We're not just talking about their first deposit. We're talking about the total amount of revenue you can reasonably expect to make from that one person over their entire time with you.
And on the other side of the coin, you have CAC, the customer acquisition cost. This one's pretty simple. It's all the money you spent on sales and marketing divided by the number of new customers you got. This is the cost part of our compass.
So, what's the magic number? What should you be aiming for? It's 3 to 1. If a customer's lifetime value is at least 3 times what you spent to get them, you're in a healthy spot. Your business is built to last. But if it's less than that, you're probably in the danger zone.
All right, so the big question is, how do you actually get your ratio above that golden 3 to 1 mark? Well, let's open up the toolkit. We're going to look at 3 really powerful levers you can pull right now to lower your CAC.
First up, automate, automate, automate. I can't say it enough. Every single manual process you have is just a drain on your time and your money. When you automate things like know your customer checks or the whole onboarding process or even your basic marketing campaigns, you slash your operational costs. It frees up your team to focus on the big picture stuff.
The second lever is all about working smarter, not just harder. Stop the guesswork. When you use AI-driven analytics, you can actually start to predict what customers will do. This means you can target only the people who are most likely to convert, and you stop wasting money on ads that are going nowhere.
And number 3, you have to be absolutely ruthless about where your marketing budget goes. You need to figure out which channels give you the best return on your investment and then double down on those.
I mean, just look at the trade-offs. Sure, paid ads get you fast results and a really broad reach, but man, are they expensive. A referral program, on the other hand, yeah, it's a bit slower to build up steam, but it brings in super high-quality leads for a tiny fraction of the cost. And the data totally backs this up. A really solid referral campaign can chop your CAC by up to 30% compared to just throwing money at paid ads. That is a massive, game-changing difference to your bottom line. But, there's a secret weapon in this whole fight against high CAC that a lot of companies just overlook, and that's customer retention. Because let's be real, the cheapest customer to acquire is the one you never have to lose in the first place.
It's a really simple equation when you think about it. The fewer customers you lose, that's your churn rate, the fewer new ones you have to go out and acquire. Every single customer you manage to keep is one less you have to pay to replace. It directly lowers your overall CAC. Simple as that.
And this creates this amazing, powerful feedback loop we call the retention flywheel. It works like this. You keep your current customers happy, so they stick around. That reduces the pressure on you to constantly be finding new people. Then those happy customers start telling their friends, and they bring you high-quality new customers for free. The result? Your CAC just plummets. So, as we start to bring this all together, you can start to see a really clear path forward. It's not about finding one magic bullet. It's about a smart strategy that combines financial discipline, smart tech, and just a relentless focus on keeping your customers happy. And looking to the future, the tools to do this are only getting better.
AI is going to allow for incredible hyper-personalization. Things like blockchain could make those KYC checks almost instant, and smarter marketing will help unlock new, untapped markets where there's way less competition.
So if you remember nothing else from all this, please remember these 3 things. 1. That 3-to-1 LTV to CAC ratio is your North Star. Follow it. 2. Automate everything you possibly can. It will cut your costs and make you more efficient. And 3. Treat customer retention not as an afterthought, but as your single greatest asset for growth.
And that really brings us to the end. The path to profitable, sustainable growth is right there. It's clear. So the only question left to ask is this. Now that you've got the toolkit, what's the very first move you're going to make?